Launching a digital lending app in India requires navigating two primary regulatory pathways. Whether you aim to become a licensed NBFC or partner as a lending service provider with an established entity, this video maps out the regulatory landscape, including compliance with Reserve Bank of India directions. There are two distinct pathways to market. Path A involves becoming a licensed NBFC yourself, offering full control but requiring significant capital and a longer timeline. Path B allows you to partner as a lending service provider, which is faster and does not require an RBI license, but keeps the lending risk and core policies with the partner. This table compares both paths. Path A requires 10 crore in net-owned funds and takes up to 18 months, whereas Path B has no such mandate for the app entity and typically takes 2 to 4 months to launch through tech integration. We now dive into Path A, becoming a regulated entity. This journey moves from company incorporation to securing your certificate of registration and finally issuing your first digital loan. Step 1 of this process starts with incorporating your company with a lending clause, determining your NBFC category, meeting the 10 crore net-owned fund requirement in a scheduled bank, and filing your application for a certificate of registration through the RBI's Cosmos portal. Step 2 involves organizational checks. You must identify your scale-based regulation tier, ensure directors and promoters pass fit and proper criteria, and handle FEMA and FDI compliance if there is foreign investment in your entity. The final step for Path A is ongoing compliance. From launch day, you must track capital adequacy, maintain a board-approved fair practices code, ensure grievance redressal mechanisms are live, and adhere to all RBI reporting and audit schedules. Alternatively, Path B involves becoming a lending service provider, or LSP. This allows you to focus on building a multi-lender marketplace by partnering with an existing NBFC. As an LSP, you act on behalf of a regulated entity. You are permitted to manage customer acquisition, tech support, and loan servicing, but you are strictly prohibited from independently making credit decisions, pooling borrower funds, or charging fees directly to the borrower. The process for an LSP starts by selecting a partner NBFC. After passing their due diligence and executing an LSP agreement, you build your app, have your partner report the digital lending app on the CIMS portal, and then go live. Regardless of your path, a robust regulatory stack governs all digital lending. This includes the RBI's 2025 Digital Lending Directions, the Companies Act, the Information Technology Act, and data protection laws, among others. Your launch requires several board-approved policies to be in place. These include your Fair Practices Code, digital lending and outsourcing policies, as well as necessary IT, data privacy, and grievance handling frameworks. Furthermore, you must have specific contracts executed before going live. This includes your LSP agreement, loan agreement templates, data processing agreements, and, if applicable, agreements for default loss guarantees or co-lending arrangements. Borrower-facing requirements must be integrated directly into your app's flow. This includes showing a key fact statement before contract execution, enabling a cooling-off period, providing direct fund transfers, and ensuring fair display of lender information. Finally, your technology systems must meet strict operational standards from day one. These include data localization within India, audit-trailed consent, active reporting on the CIMS portal, credit information company reporting, and the ability to handle breach notifications and inspections on demand. This slide outlines the end-to-end launch timelines for both pathways. Path A takes 9 to 18 months to reach the first loan disbursement, while Path B typically requires 2 to 4 months, provided all documentation is complete and no adverse issues arise during the review. It is crucial to understand the risks of non-compliance. Issues can lead to the closure of your digital lending app, monetary penalties, personal liability for directors, damage to your business reputation, or legal action from the Data Protection Board. Before you launch, consult this final go/no-go checklist. Ensure your legal pathway is selected, agreements are executed, all required board-approved policies are in force, your app is fully integrated with mandated consumer protections, and all necessary listings and appointments are complete. If you require further information or assistance with your digital lending roadmap, please reach out to us at the contact email shown on the screen.